are back for another Talk About It Tuesday. And we have somewhat of a philosophical question, but I'm going to really break it down for you and try to give you a good answer so that it's very usable. So here's the question. Haru, what is the difference between being wealthy and financially free? Believe it or not, I get that question a lot. Because I'm always preaching financial freedom. I'm saying you have to be financially free, financially free. And we've always been taught to try to be wealthy. And what is being wealthy? And I think a lot of times wealthy is based on people having this idea of a high net worth, right? So what is a high net worth? Traditionally, a high net worth. Well, let's talk about what net worth is. Net worth is your assets minus your liabilities, right? And when we talk about assets, people talk about things like property minus your liabilities, the costs associated with it. That equals your net worth. So so let me break that down a little further because I know that still sounds like a bunch of financial mumbo jumbo. There are people that I know in New York City who have become millionaires, and a person who has between 1 to 5 million is considered high net worth, right? And that's important. Who have become millionaires due to no effort of their own. And so they would be considered high net worth, which would mean that they're wealthy. Let me tell you how they became millionaires by accident. Back in the 1990s, many of them purchased brick townhouses or brownstones or limestones in Brooklyn, in central Brooklyn, for about $130,000. And today, many of those same properties are worth 1.5, $2 million simply because New York City has changed, the demographics has changed, the capital investment that's come in has changed, the political will to make the neighborhoods different has changed. So due to no effort of their own, except that they bought at the right time, not even with the understanding or the idea or the concept that it would grow in value so vastly, they become high net worth individuals, millionaires. So technically they are wealthy. But here's the funny thing. As wealthy as they are still not financially free. So what does it mean to be financially free? So financial freedom is not based on a number. You can have $1 to $5 million and still not be financially free. You can have $20 million and still not be financially free. So financial freedom comes from the income generated from passive income, meaning the income generated from your passive income covers the lifestyle of your choosing. And if the lifestyle that you choose can be financed by $100,000 a year and you make $100,000 a year in passive income, then you're financially free, even though you're not a millionaire, right? So what does it boil down to? We talked about assets create wealth, right? And we talk about the net value of an asset. But there are two different types of assets. There are equity producing assets and there are income producing assets. So let me break that down a little further so that you understand, I think, the balance of how much you should own in assets that produce income and assets that produce equity. So what is equity? Equity, again, goes back to that same idea of net worth. It's the difference between what something is worth and what you owe on it, right? So let's use real estate because that's easy. If a property is worth $500,000 and you currently have a $450,000 mortgage on it, meaning you owe $450,000, then the equity is the $500,000 minus the $450,000. There's $50,000 in equity, right? So the net equity that you have is $50,000. So you're worth $50,000, right? So how is that valuable? So let's go back to the people who bought in the 1990s. They paid $130,000 and now it's worth 1.5 million. There's a tremendous amount of equity there. However, they're still living paycheck to paycheck, so they're not financially free, right? So what is the value of having an equity producing asset? Well, there's three major values to it. The first major value to it is at some point you can sell that asset and then collect the cash from the equity, right? So if you sold it for 1.5 million and you only owed, 1.2 130,000, then you're getting $1 million plus, and then minus the taxes, right? So you got $1 million cash now that you can do whatever you want with. So major value in an equity producing asset is that you can sell it and collect the equity. Now, equity producing assets tend to, in some cases, take many years to accrue the equity. And the equity changes based on the cycles of the times, right? So we go in a recession, that equity shrinks due to no effort of your own. We go into, a growth cycle, and the equity grows due to no effort of your own. So the effort that you have in putting it in is paying down, let's say a mortgage, if it was a piece of real estate, or paying down whatever the costs are to acquire it. So mostly the equity can ebb and flow due to no effort of your own, just based on economic cycles and times, right? The whole neighborhood could change and you lose all the equity. The whole neighborhood could change and you gain tremendous amounts of equity. So equity producing assets have the value of, you can sell it, right? That's one value. The second major value you have is when it has a lot of equity, you can, what we call, leverage that, meaning you can borrow against the equity that's in the property, and you use the property as collateral on the loan, right? So you can refinance it, you can get a private loan, whatever it is. However, if you fail to pay back the loan, then they get the asset, right? They take the asset from you to pay it so they can sell it and recoup their money. So you can sell it, you can borrow against it. The third major benefit of having equity producing assets, especially if you intend to have it for a long time, is that you can pass it on intergenerationally easily. So a person bought a property at 130,000 in the 1990s. They had children in the 1990s. Their children are now adults. If something happened to them, or if they just chose to do it now, they can transfer that wealth onto the next generation. So you just handed $1 million to your children. So the ability to easily transfer wealth intergenerationally is another value of having equity producing assets. However, if your primary goal is financial freedom, then you can't just have equity producing assets. You have to have income producing assets. So what is an income producing asset? Let's look at another piece of real estate, not the place you live in, but a second property where you rent out each unit. So not only is it gaining equity, right? And that's just a plus with the real estate, but it's also generating income every single month. Every single month you get money from it. And that income that's generated from it should help to cover the cost of the lifestyle that you choose, right? So instead of choosing a lifestyle based on what you can afford, you buy enough properties, right? Or enough other assets, and it could be stocks or other things that produce dividends or interest income. You have all these assets that produce income that covers the lifestyle of your choosing. So that will make you financially free. So when you're thinking about acquiring assets, you got to think about that balance. How much do you need that will produce income for you? And how much do you need that you kind of hold in reserve to either sell, borrow against, or pass on to the next generation? So that's really, in a nutshell, the difference between being wealthy, again, these assets that produce, equity, and being financially free, these assets that produce income that support the lifestyle of your choosing. So again, hopefully that answers that philosophical question. Hopefully it also gives you a practical idea of when you're doing asset acquisition, when you're acquiring assets, what things that you want to accumulate in what ratio, right? So you have to have enough assets that produce the income to support your lifestyle. And then you have to then have some assets that you kind of hold in reserve in case you need to borrow against or sell to get cash flow. To get cash, a lump sum of cash, and or to be able to pass on to future generations. So keep the questions coming, and I'll see you next Tuesday.